There are three financial positions that have survived every economic catastrophe in the last 100 years. Not most crises, not some downturns, every single one. The Great Depression of 1929, the Stagflation Crisis of the 1970s, the dot-com crash of 2000, the 2008 financial meltdown, and the COVID pandemic of 2020. 5 major crises spanning a century, 5 completely different causes: stock crashes, inflation spirals, housing bubbles, tech speculation, global pandemic. Yet the same 3 positions not only survived each crisis, they thrived while everyone else was losing everything. Position 1 protected wealth when stocks dropped 89% in 1929. Position 2 generated income when inflation hit 14% in 1980. Position 3 multiplied value when real estate crashed 40% in 2008, and all 3 survived. COVID when 50 million Americans lost their jobs in 60 days. The people who held these positions didn't just survive. They bought assets at the bottom from desperate sellers and became wealthy during the recovery. Right now, in 2025, we're seeing warning signs identical to the months before each previous crisis. Commercial real estate defaults are accelerating. Regional banks are failing. Corporate debt is at all-time highs. Credit card delinquencies are spiking. Consumer confidence is dropping. The yield curve has been inverted for 18 months. Every indicator that preceded the last 5 crises is flashing red simultaneously, and most people are positioned exactly wrong, holding the same assets that got destroyed in every previous crash. Welcome to Finance Folder, where we decode patterns in financial history to help you protect and grow your wealth. If you find value in this analysis, subscribe to the channel and hit the like button so more people can learn these lessons before the next crisis hits. This isn't speculation. This is pattern recognition across 100 years of documented financial history. Let me show you what happened in each crisis, which positions survived, which assets were destroyed, and why the same 3 positions work regardless of what type of crisis occurs. Then I'll show you the warning signs appearing right now and how to position before the next one hits. The Great Depression 1929 to 1933. The stock market annihilation on October 24, 1929. Black Thursday, the stock market began its collapse. By October 29th, Black Tuesday, panic selling had erased 25% of market value in 2 days. But that was just the beginning. Over the next 3 years, the Dow Jones fell from 381 points to 41 points, an 89% decline. 9 out of every $10 invested in stocks vanished. Banks failed by the thousands. Between 1929 and 1933, 9,000 banks closed their doors. That's 1/3 of all banks in America. People who had savings accounts lost everything when their bank collapsed. There was no FDIC insurance. If your bank failed, your money was gone. Unemployment reached 25%. 1 in 4 working Americans had no job. Wages for those still employed fell 42%. GDP dropped 30%. Industrial production fell 47%. The economy didn't just slow down, it collapsed. Stocks were the worst position to hold. Bank deposits were the second worst. Millions of Americans had their life savings in banks that failed. The money simply disappeared. No insurance, no recovery, nothing. People who thought their money was safe because it was in a bank lost everything. Bonds seemed safe, but many corporate bonds defaulted. Companies went bankrupt and bondholders got pennies on the dollar, or nothing at all. Even government bonds lost purchasing power during the deflationary spiral. So what positions survived and thrived? Position 1. Direct ownership of productive agricultural land, farmland, held its value and generated income throughout the Depression. Here's why. People still needed to eat. Food demand didn't collapse like demand for cars or luxury goods. If you owned productive farmland and could grow crops, you had income. You could feed your family. You could sell or barter your production. Farm foreclosures did happen, but primarily on mortgaged land. Farmers who carried heavy debt loads couldn't make payments when crop prices fell and banks foreclosed. But farmers who owned their land outright, with no mortgage, survived. They had food, they had shelter. They had something of value when everything else was collapsing. Moreover, people with cash who bought farmland during the Depression at distressed prices made fortunes. Land that sold for $100 per acre in 1928 could be bought for $30 per acre in 1933, when the economy recovered. That land was worth $200 per acre by 1950. The people who bought agricultural land during the Depression multiplied their wealth while stock investors were still recovering their losses 20 years later. Position 2. Physical gold and silver. In 1933, President Roosevelt issued Executive Order 6102, requiring Americans to turn in their gold to the government. The official price was $20.67 per ounce. Then, after collecting the gold, the government revalued it to $35 per ounce in 1934. That's a 69% increase overnight. People who held physical gold before the confiscation order and either turned it in or kept it hidden saw massive gains. Those who turned it in and received dollars could immediately buy assets at depression prices. Those who kept it hidden had wealth that maintained purchasing power while everything else deflated. Silver wasn't confiscated and performed even better for those who held it. During the Depression, silver's purchasing power increased dramatically because deflation made the metal more valuable in dollar terms, while its utility remained constant. Position 3. Cash to buy distressed asset. This might seem counterintuitive because I just said bank deposits were dangerous, but there's a critical distinction. Cash in a failed bank was lost. Cash held outside the banking system, or in banks that survived, was king. During the Depression, asset prices collapsed. Stocks, real estate, businesses, all were selling for 10 to 30 cents on the dollar. The people who had preserved cash and had the courage to buy when everyone else was panicking became wealthy. Rockefeller doubled his wealth during the Depression by buying assets at fire sale prices. Joseph Kennedy, JFK's father, made his fortune buying stocks and real estate at the bottom. Paul Getty bought oil company shares when they were trading below the value of the oil in the ground. These men weren't lucky. They had cash, and they bought when assets were cheap. The pattern? Productive real assets that generate necessities, hard monetary metals, and purchasing power to buy distressed assets. These three positions survived and thrived. The 1970s stagflation, the inflation destruction. The 1970s presented the opposite problem. Instead of deflation and depression, the economy suffered stagflation, simultaneously high inflation and low growth. From 1973 to 1982, inflation averaged 9% annually. In 1980, it peaked at 14.5%. Meanwhile, GDP growth was anemic, and unemployment was high. The stock market went nowhere for a decade. The Dow Jones was at 839 in 1973 and 875 in 1983. That is basically zero nominal return over 10 years. But when you adjust for inflation, stocks lost 60% of their purchasing power. If you had $100,000 in stocks in 1973, by 1983 you still had $100,000 nominally. But it could only buy what $40,000 could buy in $1,973. Bonds were catastrophic. The worst performing asset of the decade. If you owned bonds paying 6% interest while inflation was running 10 to 14%, you were losing 4 to 8% per year in purchasing power. Long-term bondholders saw their principal value destroyed. A 30-year Treasury bond issued in 1970 at par was worth 50 cents on the dollar by 1980 because interest rates had risen dramatically. Cash in savings accounts was destroyed. Banks were paying 5 to 6% interest, while inflation was 10 to 14%. Anyone holding cash was losing 4 to 8% annually in purchasing power. A $100,000 savings account in 1973 was worth $40,000 in purchasing power by 1983. So what survived the 1970s inflation? Position 1. Income-producing real estate. Real estate was the top performer of the 1970s. Home prices increased 10 to 12% annually, matching or exceeding inflation. But more importantly, rental income increased with inflation. If you owned an apartment building, your rental income went up 10% per year, while your mortgage payment stayed fixed. This created a powerful dynamic. Your debt was being inflated away while your income was rising, and your asset was appreciating. A property purchased in 1973 with a $100,000 mortgage at 7% interest had the same $665 monthly payment in 1983. But by 1983, that $665 payment had the purchasing power of $266 and $1,973. Meanwhile, rents had doubled or tripled. Real estate investors in the 1970s became wealthy not through appreciation alone, but through the combination of rising income, inflating away fixed-rate debt, and asset appreciation. It was the perfect inflation hedge. Position 2. Commodities and precious metals. Gold went from $35 per ounce in 1970 to $850 per ounce in 1980. That's a 2,300% return in a decade. Silver went from $1.50 to $50. Oil went from $3 per barrel to $40. Agricultural commodities doubled or tripled. Commodities outperformed every paper asset by an enormous margin because they have intrinsic value. An ounce of gold is an ounce of gold regardless of what currency it's priced in. As the dollar lost purchasing power due to inflation, it took more dollars to buy the same commodities. People who held gold, silver, oil, agricultural commodities, preserved and multiplied their purchasing power. Position 3. Productive businesses with pricing power. Companies that produced essential goods and services and could pass price increases to customers thrived. Energy companies, food producers, utility companies, all did well because they could raise prices with inflation. Berkshire Hathaway, run by Warren Buffett, returned 20% annually during the 1970s while the stock market was flat. How Buffett owned businesses that generated cash flow and had pricing power. He bought more businesses during the decade at reasonable prices while other investors were panicking. The pattern repeated. Real assets that produce income, hard monetary metals, and productive businesses. These survived inflation while bonds and cash were destroyed. The 2008 financial crisis, the credit collapse, the 2008 crisis was different again. This was a credit collapse triggered by a housing bubble. Housing prices had doubled between 2000 and 2006. Subprime mortgages, adjustable rate loans, and speculation had driven prices to unsustainable levels. When the bubble burst, everything connected to credit collapsed. The stock market fell 57% from its 2007 peak to its 2009 low. The S&P 500 went from 1,565 to 676. If you had $100,000 in stocks in October 2007, you had $43,000 by March 2009. Housing prices fell 40% nationally. In some markets like Las Vegas and Phoenix, they fell 60%. Homeowners who had bought at the peak suddenly owed more on their mortgages than their houses were worth. Foreclosures exploded. Millions of families lost their homes. Corporate bonds crashed. Lehman Brothers went bankrupt. Bear Stearns was sold for $2 per share after trading at $170. Washington Mutual failed. Wachovia failed. Dozens of banks collapsed. Credit froze. Banks stopped lending. Even credit-worthy borrowers couldn't get loans because banks were hoarding cash to cover their own losses. The financial system came within days of complete failure. What survived 2008? Position 1. Unencumbered cash and treasury bonds. Cash was king in 2008 because everything was on sale. The people who had cash and the courage to buy in March 2009 made fortunes. Stocks that had fallen 60% recovered 100% or more within 3 years. Warren Buffett deployed billions during the crisis, buying Goldman Sachs, Bank of America, and other distressed companies at bargain prices. He made billions because he had cash when everyone else needed it desperately. Treasury bonds also performed well because investors fled to safety. While corporate bonds crashed, U.S. Treasury bonds rallied as people sought the safest assets. 10-year Treasury yields fell from 5% to 2%, meaning bond prices rose substantially. Position 2. Gold went from $800 per ounce in 2008 to $1,900 per ounce by 2011. It served as a crisis hedge. When confidence in the financial system collapsed, investors bought gold. When central banks began printing trillions of dollars in quantitative easing, gold appreciated because people feared inflation. Position 3. High-quality dividend-paying stocks bought at the bottom. The key was bought at the bottom. Stocks that paid reliable dividends and were purchased in late 2008 or early 2009 generated spectacular returns. Companies like Johnson & Johnson, Procter & Gamble, Coca-Cola, all fell 30 to 50% despite being financially sound businesses that continued paying dividends. If you bought these stocks at the bottom, you got a 6 to 8% dividend yield plus 100 to 200% capital appreciation over the next 5 years. But you needed cash to deploy and courage to buy when the news was terrifying. The pattern: cash for purchasing power, hard monetary assets as crisis hedges, and quality productive assets bought at distressed prices. COVID 2020, the pandemic shock. COVID was unique. A global pandemic shut down the economy overnight. In March 2020, stock markets fell 35% in 4 weeks, the fastest crash in history. Oil prices briefly went negative. Unemployment hit 14.7% in April as 50 million Americans lost jobs. But this crisis was also unique in the response. Governments and central banks printed money on a scale never seen before. The U.S. alone printed $5 trillion in 18 months. Interest rates went to zero. Stimulus checks were sent to households. The entire economy was propped up by unprecedented monetary and fiscal intervention. The result was strange. Some assets crashed, others surged. The economy split into winners and losers based on whether you could operate during lockdowns. What survived and thrived? Position 1. Technology and remote work stocks. Companies that enabled working from home exploded. People who held tech stocks or bought during the March crash made enormous returns. The Nasdaq, which fell 30% in March, recovered by June and was up 40% by year-end. Position 2. Residential real estate housing prices surged during COVID because of 3 factors. Interest rates dropped to 2.5 to 3%. People wanted more space to work from home, and stimulus money increased demand. Housing prices rose 20 to 30% in many markets between 2020 and 2022. People who owned real estate saw their net worth increase dramatically. Those who bought during the brief March-April panic, when some sellers dropped prices, bought assets that appreciated 30% in 2 years. Position 3. Bitcoin and cryptocurrency. Bitcoin went from $5,000 in March 2020 to $69,000 in November 2021. That's a 1,280% return in 20 months. Why? Because central banks printing trillions of dollars made people fear inflation and currency debasement. Bitcoin was seen as digital gold, a hedge against unlimited money printing. People who held or bought Bitcoin during the crisis multiplied their wealth. The pattern shifted slightly, but the core held. Productive assets in growing sectors, real assets that couldn't be printed, and assets that benefit from monetary expansion. The common thread across all 5 crises: look at what survived every crisis. Real productive assets, farmland in the Depression, real estate in the 1970s, quality businesses in 2008, tech stocks and COVID hard monetary assets, gold and silver in Depression in 1970s, gold in 2008, Bitcoin in COVID cash, or purchasing power at the bottom to buy distressed assets in Depression in 2008. What failed in every crisis? Overleveraged speculation, margin stocks in 1929, speculative real estate in 2008, fixed income paper assets during inflation, bonds in the 1970s, cash during hyperinflation, though this hasn't happened in the US yet, concentrated risk, being Elon on one asset class. The 3 positions that work in any crisis based on 100 years of evidence. Here are the 3 positions that survive regardless of crisis type. Position 1. Ownership of productive real assets with multiple use cases. This means agricultural land that produces food, residential real estate that provides shelter, businesses that produce essential goods or services, infrastructure assets like utilities, transportation, energy. The key is productive and essential. A vacant lot isn't productive. A luxury yacht isn't essential. But farmland produces food, rental property produces shelter and income. A utility company produces electricity. These assets maintain value because they fulfill basic human needs. In deflation, they generate income when everything else fails. In inflation, they appreciate and generate rising income. In a credit crisis, they have intrinsic value independent of financial system function. In a pandemic, essential businesses continue operating. Position 2. Hard monetary metals with thousands of years of value recognition, gold and silver, have been recognized as valuable for 5,000 years across every civilization. They're no one's liability. They can't be printed. They have intrinsic utility in industry, jewelry, and as store of value. In every crisis, a portion of your wealth should be in physical gold and silver, not gold ETFs or paper gold. Physical metal you can hold. 5 to 15% of net worth is reasonable. Gold preserves purchasing power across currency debasement. It rallies during crises when confidence in financial systems falls. It's liquid and globally recognized. You can sell it anywhere in the world for local currency. Position 3. Dry powder cash to deploy when asset prices collapse. This is the most psychologically difficult position because holding cash feels unproductive during good times. Cash doesn't generate yield. It loses purchasing power to inflation. But cash gives you options. When crisis hits and assets fall 40 to 60%, the person with cash can buy generational wealth at fire sale prices. This requires 2 things: having cash available and having the emotional courage to buy when everyone else is panicking and the news is terrifying. You don't need 50% in cash, but 10 to 20% of your portfolio in cash, or very short-term treasury bills, gives you ammunition to deploy opportunistically. Warning signs of the next crisis right now. Multiple indicators are flashing the same warnings that preceded previous crises. Commercial real estate distress, office buildings are 40% empty due to work from home. Commercial mortgage defaults are rising. Banks that lent heavily to commercial real estate are exposed. This resembles the housing crisis lead up in 2006-2007. Regional bank failures: Silicon Valley Bank, Signature Bank, First Republic, all failed in 2023. Banks are sitting on unrealized losses from bonds purchased when rates were low. If depositors panic and withdraw, more banks could fail. Yield curve inversion. The 10-year Treasury yield has been lower than the 2-year Treasury yield for 18 months. This yield curve inversion has preceded every recession in the last 50 years. The recession typically starts 6 to 18 months after the inversion ends, and the curve normalizes. Credit card delinquencies. Rising credit card debt is at $1.2 trillion, an all-time high. Delinquencies are rising as consumers exhaust their savings and can't keep up with 22% interest rates. This indicates consumer financial stress. Corporate debt refinancing wall. $2 trillion in corporate debt matures between 2024 and 2026. Much of it was issued when interest rates were 2 to 3%. Companies will have to refinance at 6 to 8%. Many won't be able to afford the higher payments. Defaults and bankruptcies will rise. Geopolitical instability, wars in Ukraine and the Middle East. US-China tensions. These create supply chain risks, energy price spikes, and potential for broader conflict that could trigger economic crisis. None of these guarantees a crisis will happen in 2025 or 2026, but the warning signs are present, and history shows that when multiple indicators align, crisis risk is elevated. How to position for the next crisis based on the lessons from the last 100 years. Here's what you should consider. 1. Build real asset foundation. Own productive real assets that generate income. If you can afford real estate, own rental property with positive cash flow. If you can't, own stocks of companies that produce essential goods, utilities, food, healthcare, energy. Avoid speculation. Avoid meme stocks, NFTs, anything that relies purely on greater fool theory. Own assets with intrinsic value and income generation. 2. Hold 5 to 15% in physical precious metals by physical gold and silver. Store it securely. This is your insurance policy. If the financial system has a crisis, if currency is debased, if confidence collapses, precious metals preserve wealth. Don't trade gold. Don't try to time it. Hold it as long-term insurance. 3. Keep 10 to 20% cash for opportunities. This is hard psychologically when markets are rising, but having dry powder lets you buy when crisis hits and prices collapse. Keep this cash in treasury bills or money market funds at highly stable banks. You want it to be liquid and safe, ready to deploy when opportunity appears. 4. Avoid excessive leverage. Leverage amplifies gains, but destroys you in downturns. If you own real estate with mortgages, make sure you have enough cash flow and reserves to handle 6 to 12 months of vacancy or income loss. Margin debt on stocks is dangerous. If markets fall 40%, you can face margin calls that force you to sell at the bottom. 5. Diversify across asset types. Don't be 100% stocks or 100% real estate or 100% any single thing. Have a mix of productive assets, hard monetary metals, and cash. This ensures no single crisis type wipes you out. 6. Stay informed, watch the indicators. Track commercial real estate defaults, monitor bank stress. Follow the yield curve. When multiple signals flash red, reduce risk and increase cash position. Subscribe to Finance Folder for ongoing analysis of these indicators. We'll track the warning signs and help you understand when to be defensive and when to be aggressive. The fundamental lesson across 100 years and 5 major crises, the pattern is clear. The people who survive and thrive are those who own productive real assets. Not paper promises. Hold hard monetary assets that can't be printed or inflated away. Keep purchasing power available to buy when everyone else is panicking. Avoid excessive leverage that forces them to sell at the worst time. Have diversification across asset types. The people who lose everything in every crisis are those who hold concentrated positions in single assets or sectors. Use heavy leverage that creates forced selling, panic, and sell at the bottom. Hold paper assets that depend on the financial system functioning perfectly. Believe this time is different. History doesn't repeat identically, but it rhymes. The next crisis won't be identical to 1929, 1970, 2008, or 2020. But it will follow similar patterns. Assets will reprice. Leverage will be punished. The prepared will buy from the desperate. Wealth will transfer. The question is, will you be positioned correctly? The 3 positions that have survived every crisis for 100 years are available to you right now. Productive real assets, hard monetary metals, cash for opportunity. Build these positions now, before the next crisis hits. If you found this valuable, subscribe to Finance Folder and like this video. Share it with anyone who needs to understand these patterns. The next crisis is coming. The only question is whether you'll be ready. History has shown us the playbook 5 times. Now it's up to you to apply the lessons before the 6th crisis arrives.